How's it going, everyone? I just want to spend a few minutes today on 3I Group, and in particular, just look at a few of the little details that come together to make Action, their primary investment, such an impressive company. As always, this isn't investment advice. So first, what is 3I Group? 3I is basically a private equity company which has shifted a number of years ago to basically only manage their own permanent capital. They manage a little bit of outside capital on some other infrastructure fund and some other things, but mostly their own capital. And what they do with this is they buy significant stakes in private companies, and they are long-term growth investors. And over the years, that has led them to have a significant portfolio, which looks like this. Now, as you can see, the biggest name in the portfolio is Action, which is a general merchandise discount retailer, but they do have a number of other stakes. Now, at this point, Action is almost 18 billion of the 24 billion pounds, so most of it. Royal Sanders is their second largest position, followed by the 3i Infrastructure Fund. There's been a number of names that they have, some that are growing very impressively. And if you look through the portfolio, you find some really interesting things like Tato, which they bought in 1989. So long-term investors, and even Tato, they show a 13 million dividend. And in addition to that, it's, almost approaching 200 bagger on their cost. So long-term holders. And the interesting thing about that I also want to draw the attention to is that over time, the size of their positions has increased as they have grown. Now, Action on this slide, you can see the residual cost that includes many follow-on investments. I'll get to what it was initially in a minute. But they have a portfolio, they have some sectors that they like, and overall, as a portfolio, for a number of years now, they have generated some pretty solid returns on equity. And much of that has come in a period where Action was a smaller percentage of the portfolio, so it was more of, on a portfolio level, they have broadly generated solid returns. Now, of course, Action was a big part of that, and at this point, I'm probably sound like action. You're like, what is that? Well, I'll get into it. But often when I'm thinking about Action, I'm reminded of that Warren Buffett joke. The joke where he goes that him and Charlie were on a plane, and they had their plane hijacked, and the hijackers said or decided that they were the bad capitalists, but before they killed them, they were going to give them one final request. And Charlie's request, Charlie Munger that is, was that he wanted to teach them or explain to them all the virtues of the business Costco. Hearing that, Warren said, "My request, just shoot me first." Action, as I mentioned before, is a discount retailer that 3i now has a almost 58% stake in. They first bought their stake in 2011 for 114 million pounds, and the stake has grown to be worth now more than 17 billion pounds. So how it's done this is, and this stake, most of the time the mark has been similar at 18.5 times EV to run rate EBITDA. So the growth has all come from EBITDA growth, earnings growth, and it has done this through fantastic unit economics, both at the store level and the product level. And it should still have a significant runway for growth ahead. Now, I'm not going to spend much time on the valuation here, but I do know that anytime you mention EBITDA and anytime you mention something like 18.5 times EBITDA, you lose a lot of people, especially because, a lot of people don't like EBITDA, a lot of people don't like retailers, a lot of people have poor impressions of this type of business. But I think in this case, it's, obviously everyone would always prefer to pay much less for anything. But I think in this case, it's more than justified. And if you look at it in terms of what the breakdown of the 18.5, that's 16 times is basically the market cap and 2.5 times is debt. So 2.5 times net debt to EBITDA and then 16 times market cap. So there's like an okay, like a small earnings yield component. And then there's the fact that it is capital light, which I'll get much more to in a minute. And so the multiple could be a risk longer term, went like very long term once it stops growing. But realistically, if you look at what 18.5 times run rate EBITDA means, and you fast forward to the year later and what you'd be paying on a trailing basis, it's really something more like 15, which once you consider the leverage and the business type, it's much more manageable and really doesn't seem that stretched, especially for a company that has been, well, very impressive. If you look at over the last decade, sales have grown by 24% compounded, only 22% last year. EBITDA has grown by 28% compounded, and this is not even including the capital returned. And once the stores are in place, you have it's been growing near double digits for recently, the same store sales or like for like, and then you add another 10+% of store growth and you have some really impressive numbers. But that's in the past. Do they still have room to grow, and how are they going to continue to extract the growth? Well, the first thing to note is that they currently have about 3,000 stores, and that's all in Europe. It's all around Europe. It's not all through Europe. And they believe that in their existing markets, they have a target of about 7,700 stores. Now, you can analyze that and think that's aggressive or not. One thing I can say is if you look at the markets that they're in and compare them to, let's say, Dollarama has 1,600 stores in Canada and targeting 2,200 stores by 2030. And Europe has, in the countries that they're in, has about 10 times the population of Canada. So I don't think the 7,700 stores in Europe is overly stretched, but every country has a different density and breakdown and all that stuff. So there's other stuff. But the other point is that's Europe. They still haven't entered the US, and they may or may not, and there's other countries around the world that they can still expand into. But really, when you're looking at Action, I think it's important to understand that not all the growth comes from one thing, or not all the value of owning it comes from one thing. There's both the business value that is increasing, and there's the capital returns. And there's an interesting aspect of the capital returns in the Action value proposition. But on the business, you get same-store sales or like-for-like growth, and whatever number you want to plug in there, that's a number that compounds with the other numbers, or obviously it won't stay high forever, but its growth on existing stores. And the other thing is the store count. The store count has been growing decently, as I showed before, and if you believe that will remain room to grow for another however many years, this is an area where you can still generate significant growth. And the stores, as I'll get to more in a minute, pay back very quickly and have negative working capital. Then you have the capital returns, which is the dividend or buyback, depending on if there's willing sellers or not. And then there's the releveraging component that I will explain more in a bit, but basically, as they grow, their balance sheet capacity expands, and that gives them more capital that they can, well, they don't really need it because the stores pay back by themselves, so they can return that capital to shareholders. And I just wanted to illustrate how the different components, when you kind of put them together, come to some decent numbers. Like recently, they've been growing like for likes, even with their outage in Q1 when they're switching to a new enterprise resource planning system. Even with that, they had more than 6% like for like growth. But let's say their trend is around 6%. Let's be a little conservative. Let's say the store count only grows at 8%. Again, more conservative than recently, but okay. And then we add in the dividend, which is basically take the multiple that they trade at and divide it by basically earnings, and that would be roughly dividend yield. And then you add the leverage component where the growth leads to more balance sheet capacity, which is added basically capital return, but a one-off and less of a flow of dividends. You add that up, even being basically conservative on most of the numbers, and you still get a 20+% return on the equity, basically assuming a stable valuation. And to kind of get further into the fact that I don't think the valuation is like ridiculous given the business model, this is kind of more of a framing of what a company could look like later stage, like when the growth has finally, they're struggling to find new spots to put stores and the stores are mature and they're not generating tons of like for like, maybe GDP plus inflation type of thing, but they're not getting, tons of growth. You could still, once you add up the numbers and, much less from leverage, much less like for like, much less store count, little dividend in there, and you still get, something approaching 10%. So obviously at this point you'd have to look at the risk of the multiple coming down, which could unwind a long time of growth. But I'm just saying that the multiple isn't absurd because as the multiple goes down, the capital returns go up. So that's just one of the components. On the other hand, if you were to look at numbers closer to what had been put up recently, you could see that 8% like for like, 11% store count growth, dividend, and more benefit from the relevering up, you can see that the returns really add up to something more than average. Now, to drill a little further into the how of it, or the impressive part, I want to highlight 2 key points. One, new stores pay back in about 8 to 9 months. That's pretty high return on investment in every time they are opening a store. The other really interesting point that, some might shrug because it's more of a one-off, but every $1 million in dollars or pounds or euros or whatever currency they happen to open the store in, every 1 million in EBITDA growth generates 2.5 million at, call it the midpoint, of balance sheet capacity that they can return to shareholders. So what does this mean? Well, let's walk through what an investment in a new store will look like to really understand why this business model is just so impressive. So CapEx for a new store is 500,000 euros. Okay, so they open a store and it's basically immediately profitable, and then starts paying back. So the store in its first year will make about 700K. So that's 140% return on investment. Not bad, but let's say that's not enough for you. Well, you then have a store that makes 700,000 euros. I put a dollar sign, but that's just for an example purposes. Well, then you have the store that makes 700,000 euros, which adds to the balance sheet capacity. The balance sheet goes from can now support between, let's say, 2 to 3 times, would support 1.4 million to 2.1 million in added debt capacity. So they can take that debt, and let's assume this is a closed circuit, so there's plenty of capital, plenty of profits to invest in other stores elsewhere. So what do they have? They have 1.75 million of balance sheet capacity that they don't really need. So they take that 1.5 million and effectively return it to shareholders. And so the multiplying the initial, the return on the initial investment, don't know how you want to calculate that, but spend 500,000, get 700,000 a year plus 1.75 million as a one-off bonus. Not that bad. Plus, then you have a store that operates and generates profit and will continue to grow by low to mid single digit like for like same store sale growth and generate a profit, and those profits can pay dividend, and you're getting a levered return on those profits. So this is the type of thing where if there's a runway for growth, you know, it's the type of business that you just want to keep investing in. Now, of course, the how of it, I would have to oversimplify because there's many aspects, but the crux of the matter is that they generate this value by providing the best value to customers. They have the lowest price, which means they get more traffic, which means they get high turnover, which means they get benefits of volume and working capital, and just everything just kind of works with the next aspect. And this generates a lead that they have in price, which becomes harder and harder to compete with. And at present, in many of the markets where they operate, they have a significant lead. And, you know, there's two ways of looking at this. One is that they can perhaps increase prices, increase margin, and grow the profits. The other is that it is very difficult, it would probably be very difficult for competitors to disrupt them. If they offer the best value proposition and they can make their business work with this value proposition, and they're growing and doing well the way it is, every time they add scale, every time they add a store, they deepen their competitive advantage. They get more economies of scale and become harder to compete with. And there you have a business that is, as I just put before, doing very well, and a business that works very well, and it's becoming more and more entrenched and harder to just decide, hey, I'm going to try and provide more value because, you know, they already have the scale. And yeah, I basically said much of this while I was showing the chart of them versus their peers in terms of prices. But I just find it fascinating how every aspect of the business lends itself to the next aspect in terms of, you know, low margins, high turnover, working capital benefit, economies of scale, get the people in, get the people happy, coming back. And it's just, now I mentioned this in passing a few times, and I don't quite know how to quantify the benefit of it, but they actually have negative working working capital situation, whereby the business generates more working capital than it needs. They're able to do this because basically when they buy something, they have basically 30 days to pay for it. And within those 30 days, they buy it, receive it, get it to the store, get it get it sold, and get paid for it. Then they pay for it. So basically, they have more working cap. The more inventory they have, the more basically they've been paid for that inventory already. And it's like one of those things where you can't really do much with it because you still have this liability of stuff you have to pay for, but on balance, and as the business gets bigger, it's just a really interesting concept more than a big benefit. But still, it allows growth without needing to wait for you'd have the capital or the working or borrow money or whatever, because you have all the working capital you need. Now, one of the points of contention is margin. You see some analysts expect the margin to expand. Some people talk about margin expansion, and I didn't really address it. And that's not only because I don't know. It's also because I don't know what they should do. I think there is definitely a lot of room for them to let the margin expand and still have a lead. But I'm not sure that is the wise strategy. I think that they could also easily keep the margin basically where it is and not let it expand, and do what they have been doing recently, which is when they can get better deals, when the price goes down, when they can get more volume discounts, they transfer that to the customer and they benefit from volume and while increasing their lead. So I don't know what they will choose to do. I think they probably get more longevity of the business, get more quality of the business by not increasing the margin, which is kind of backwards to say if for most people, but that's what kind of where I stand on it. But I don't know what will happen as they gain increased scale. But with Action as such a significant size of their portfolio now, and with it not really needing any more capital, you reach the point where III.I's stake in Action will basically provide them with a lot of capital as it grows. The question becomes, what will they do with that capital? It will probably be harder and harder for them to get a larger and larger stake in Action because A, they own more, B, most of the people that have been forced out have been forced out. Other private equity owners who needed liquidity. So many of them that are left are probably longer term money. And so if they can't do the buying a bigger stake, which they're looking to, then there would be dividends to the company, to III.I. The dividends which they would have to redeploy. And this is, the perfect problem to have, but the problem becomes, will they be able to scale up the deals that they've been doing to a size that is able to, if not rebalance the portfolio, but add relevant growing positions to the portfolio? Will they be able to do that well at a larger scale, or will they be able to do more deals that will effectively do the same thing except more diversified? And those are some of the things to look at going forward. Now, as I showed before, they do have some other really good investments in the portfolio, but it's always more and more difficult as the company scales up and gets bigger to deploy higher and higher amounts of capital for the same type of returns. So looking back, they have been able to do this well, but the scale of Action that Action is getting to and the scale of the dividends that it could be providing are something they haven't seen, and so that is definitely something to question and look at going forward. Well, that's most of what I wanted to say, and you probably by now have a better understanding of Buffett's answer, and you only had to listen to this once. But I hope you enjoyed, and I wish all of you a great day. Until next time.